How you guys doing today? Welcome back. Today is lesson 4, risk management. We're going to talk all about risk management. Yes. More of the same old risk management conversations. This is critical though, because this class I'm actually out every single thing we're going to cover in this class and every single lesson we're going to cover and all these questions we're going to answer. So basically we're going to go over every single question. I'm going to pose it here and say, do you know how to blank? If not, there will be a class dedicated to that question to some extent or form. We have 50 lessons. We have about 46 left to go through, so we got quite a lot of questions to go through. This won't take very long, but we're going to focus on risk management and what's it mean to properly manage risk and how to properly find reward and weigh that against the risk. Thank you. The reason I'm harping on this in the first 4 episodes is I really need you to understand that when it comes to risk management and risk versus reward, that's the foundation of everything you should be doing in the stock market. There are going to be times you want to YOLO, there's going to be times you want to have FOMO, and there's times you're going to be extremely bored in the market and you're going to want to do a trade whether you think it's a good idea or a bad idea. Emotion takes over. So I want to really base this foundation of risk management now, and so when we go through every single lesson, in the back of your head you can go, I can see how that connects to risk management, at least in some way, shape, or form. That's the goal of today. So we're going to talk about how I identify risk, how do I think about risk, how to identify reward technically and fundamentally. How can we compare risk management to our 3 analysis: technical analysis, fundamental analysis, and mental analysis? All 3 are very, very important. We'll discuss that today as well. Then we'll discuss goal setting with risk management. Is the macro goals you have making sense, and does it fit your risk management policy? Do the micro level goals, such as your day-to-day, percent return goals, week, month, just being the S&P, whatever it is, does that line up well with your risk management policy? How does risk management compare to a trading plan? Does your trading plan beat into your head how to properly manage risk written down and shown on a chart? We'll discuss that today. Does it also bring into account the macro markets? Do you understand what month it is? Do you know what index the stock that you want to trade follows? Is it an ETF? Is it in a sector that's like technology that's always going up? Is it utilities, which is a little bit slower and does have some bad months and years? Do you know that? That's part of risk management as well. We'll discuss that. And risk management and consistency. This kind of goes back to mental analysis, but also as a whole. Are you consistent in your rules? I cannot say this enough and stress it enough. We are rigid in our rules. That leads us to being flexible in our expectations, and we don't deviate from that. Do you know how to trade in the zone where you have a bunch of green days, no red? Do you truly have an edge you act on and understand it's just probabilities, and if you get the probabilities more on your side, you're more likely to win? But it's just like a casino. The prices can go where it goes. Sometimes you win, sometimes you lose. Do you understand how that works? All these types of ideas, we're going to ask these questions today. I'm going to answer them briefly and quickly today to give you an idea of what we're talking about. And then through this course, every single question here will be answered in some way, shape, or form. In the description box, as I said, go down there and check. Every one of these questions will be answered in a video. It should be linked down there. With that being said, lesson 4, risk management. Let's discuss this briefly to really get in your guys' head. Let's get into it. So when it comes to risk management, how do you properly identify risk? I think usually when I think about this question, I think with technical analysis is where I start usually. The reason is I'm a pretty good technical trader, and I think it's really easy to show in a chart where I think a good stop loss or where a good risk is going to be. You can identify convergence, which we'll discuss, and if you break below your support, trend line, POC line, whatever it is, you break that, you just get out. Right? Good technical analysis should really be the forefront of how you identify risk, in my opinion. So for example, if I showed you this chart and we have CFX here, right? If I were to say, where is your risk? Where is your reward here with no charting done? It may be kind of complicated, right? But if I were to go through with you and we go to like the 5-year, 10-year charts, whatever it is, see this beautiful uptrend like this, how it's going right now. You have a beautiful support right about here, it looks like. It's coming down. What's your risk going to be? Is it going to be this area? Is it going to be a square you draw on? Is it going to be a line that you do? There's plenty of things you can do. We'll discuss that in this class, but I think more times than not, proper technical analysis where you have great supports, resistances, trend lines, patterns, EMA lines, volume profile, indicators, all that can really help you identify the risk. You can also look at this from the fundamental standpoint. I think more times than not when it comes to risk management and just finding stocks at play, it starts with TA and then it goes to FA, fundamental analysis. There are plenty of fundamental analysis catalysts, it's a mouthful, that can also show you risk versus reward. Maybe there's an FDA approval play coming up. If it's not looking very good, the risk is increased. If it's a really good looking stage 4, a bunch of folks are buying in, insiders are buying in, hedges are buying in, maybe it's less risky. That's something to consider as well. Maybe there's world events like COVID, you got Pfizer coming out, maybe electric vehicles, so GM and Ford make more sense. Whatever it is, identifying risk always to me starts with the 3 analysis: technical, fundamental, and mental. Of course, mental can get us into our second spot. How do I think about risk? For me, and only speaking for myself, I see risk as a payment, just like with an option call. If you're gonna get an option, not go too far into this, you have to give someone else a premium, like 10, 20, 50, $100 to borrow 100 shares of theirs and then possibly act upon it. I am saying with buying equity, like I always do, just going long, going short, I see risk as the same exact idea. I have predefined risk. I say I'm gonna either hit my stop loss or hit my price target. One of those two things is going to happen. So for example, instead of being like, I hope I don't lose, I'm pretty fearful, I see it more like this. Hey, this stock looks pretty good. I'll give it a 5% stop loss, put $1,000 in. I'm now essentially thinking of it like this. I'll pay $50 to see if my edge was right. It's as simple as that. I am actually taking accountability, and I've accepted the risk that $50 may not come back to my account. No more, no less. I'm saying 5% stop loss on 1,000. I'll give out $50 and see how it goes. I see risk more like that than just some fearful, unknown circumstance. This is where flexible expectations come in. Again, every trade is unique. We're rigid in our rules. This right here, these do not change, but the expectations per trade can. My expectations can be a 2% stop loss, 4% stop loss, compared to a 10%, 30, 100% gain. Your expectations stock to stock can be flexible, but the rules that set those expectations cannot. Again, I think about risk as a payment, like a premium, and that's how I think about it. It keeps me safe and it keeps me sane. I'm not always stressed out about it. As I said, I have predefined risk. I also have predefined reward. How do we identify reward? Let's talk about that next. So when it comes to reward, to find what I think a good reward is going to be, I usually start with technical analysis, just like when it comes to identifying risk. Reward is almost equally as important, because if the reward you're going for does not make sense for the risk you're putting on, you have to consider that. This is basically the whole entire idea behind opportunity cost. If you think there's a better trade out there with better risk versus reward, so for every dollar I risk, what is the dollar amount in reward I'm potentially going for? With that same trade, if I would have said 5% stop loss and $1,000 in, am I trying to make 10%, 15%, 25%? If I'm trying to get $5 reward for every dollar I'm risking, that sounds pretty good. If the reward I'm going for is maybe 3% and I'm risking 5% for 3%, I can almost guarantee you the opportunity cost does not make any sense. What I mean by that, so opportunity cost is like this. If I were to purchase ticker ABC, whatever it is, when I purchase that, I am also saying every other ticker I didn't buy is worse than ABC. So if I'm going to buy ticker ABC, I'm also essentially saying for the reward I want, for the risk versus reward that I'm trying to get here, ABC is number one of all the stocks that I have. So make sure when you go through your scanning process, which we'll talk about, and all your technical and fundamentals and all those kinds of things, is a ticker you're trying to buy the best one for your money. This also ties back again to goal setting and all these kinds of things. Again, we'll cover this in depth much later, but again, opportunity costs and where you put your money should be in the forefront of risk versus reward and finding the best reward for your money. You could also again start with a catalyst or fundamental idea here as well. If you think that there's going to be a pharma play, you think there's going to be a legalization of maybe marijuana or some type of drug or whatever it may be from the government, maybe you see Nancy Pelosi or a politician buy something that maybe gives you an insight, hey, she bought calls for 2025 for this ticker. It's probably a good sign she knows something, whatever it may be, right? You can start from the fundamental lens to try and find your reward, but again, I think TA is the best. The main crux of risk versus reward is this. Once you decide to take on a trade, you plan that trade and you trade that plan. I don't care. You can write in a deviation of like, if this happens, I will actually do this instead. That's fine if it's written down. But if you're going to be writing a plan and not sticking to it, you have no way of knowing if your edge is even correct or if your edge is even working in the first place. You have to be able to create a plan off of your edge and see if it's successful. Plan a trade and trade that plan. It's pretty simple. With that being said, we've discussed this pretty much at length. With that being said, let's discuss risk management through the technical analysis framework real quick. So just to be clear, usually I start with technical analysis, then I move on to fundamental analysis, and then I go into mental analysis. That's the order I usually do my trading and scanning process. Charting properly with your with your edge, whatever you like to do, should give you risk versus reward. We'll talk about loading zones, stop loss, and price targets later, but I usually start there. My basis, my foundation of technical analysis is always risk versus reward, of course. Also, I think about more like this as well. Trading is about 80% technical analysis. Investing is about 80% fundamental analysis. There's a massive difference in the two. So make sure if you're doing long-term investing for years, you probably want to lean more on that crutch of fundamental over technical. If you're trading a few weeks or days, technical definitely takes precedent over fundamental in my opinion. What we're going to produce with risk versus reward is convergence. I have a whole lesson on the convergence aspect. Again, check the description box. We're going to talk all about how supports, resistances, trend lines, and patterns coming together can give you some great looking support, some great spots where bulls are going to buy in, and gives you some great clarity. That's the number one thing with beginners is clarity of your technical plays on where I think risk should be and how you can identify it. Once we are done with technical analysis, we move on to fundamental analysis with risk management. Let me start by saying this. Do you know how to properly use price targets? Again, I think a lot of folks know what they are. How do you use them? We have a lesson on that. Do you know how to properly use catalysts? I talk about 8 in this class. Do you know how to use those? We'll talk about it. Do you know what news sources to use or where to find news and how to play those kinds of plays? Because again, we'll discuss that as well. When the fundamental news breaks, is this a value purchase or a momentum purchase? Is this value or growth? We'll discuss that as well. How do you find all these things out? That's huge. We'll discuss all these things at length with risk management. Of course, risk management with the price targets. Is the price target higher or lower than the price is? If a lot of folks say higher, that's probably good for risk management. If it's lower, probably not so good. And when it comes to catalysts, do you know how to properly find one, buy in, ride momentum, or just go for the value play before it pops? How do you properly manage risk with catalyst plays? We'll discuss that as well. All these ideas with fundamental analysis and risk management will be discussed in this class. Again, the description box has all the videos for you. Probably the largest thing that's slept on with risk management is mental analysis. I think so many traders have great books, they have great knowledge, but they don't have the emotional fortitude or maturity to act upon their plans. And when the going gets tough, when the red comes, when the bears step in, are you going to stick to your plan? There are so many times I've seen fantastic, talented traders have the best plan, the best intentions, and then boom, my cat jumped. The macro markets sell off and you get scared, right? And then you don't stick to your plan, you have fear-based decision making. It's so important with mental analysis. Do you truly understand how to accept the risk? If you don't, we'll discuss that. Do you understand how to draw and plan predefined risk? Do you know that predefined risk and reward takes out emotion, which stops fear, which gets rid of expectations you can't control? We'll discuss that as well. Do you understand that fear-based decisions and hesitation are the number one reasons, in my opinion, traders' careers come to an end? They can't emotionally handle it or they blow up their accounts. We'll discuss that as well. If you ever had kind of questions about mental analysis of how to think as a trader, that trading mindset and risk management, again, we'll cover all that in this class. This structure we've been talking about is so important when it comes to mental analysis. It gives you those strength to survive. It gives you the answers to the questions you never knew you had. We'll discuss all that in this class as well. When it comes to macro markets, indexes, industries, sectors, and risk management, do you understand how to properly use those tools to your advantage? Do you look at these as gravitational forces that are going to help you or hurt you? Do you understand how the S&P and the NASDAQ and the Russell 2000 and the Dow Jones work? Do you know what stocks are on them? Do you know how sectors work? Do you know if XLF is more heavily based on NASDAQ or S&P? These are things we're going to cover, and these are things that make a huge difference, because what's going to happen is that many beginner traders with risk management look at the micro and then they go macro. No. We go macro to micro. When the indexes look bad, most tickers are going to become confused and you're not going to understand why. When the macro markets look healthy, good, uptrend, easy technicals, then we can really start to plan our trades on the micro level. We always go macro to micro. That's the first thing we're going to discuss. And of course, with risk management, do the micro trades that you're going to take on certain individual tickers fit your time frames, right? If you want to make 1% returns a day, which is pretty crazy, but if you wanted to, is a ticker that moves 0.5% a day make any sense? Not really. And if you want to kind of have a safer approach, do you want to buy a stock that moves 10, 15% in a given 15, 20 minute burst? Probably not. So again, we'll discuss that as well with macro markets and indexes, sectors, and all those industries as well. When it comes to risk management and trading plan, it's huge. Do you actually have a trading plan written? Do you know if A happens, do you go to step B? If B happens, do you go to step C? What are the steps going to be successful? Are you actually organized? Do you have something written down? Is a charting made so you can track it, watch it, change it, whatever it is? Do you have an actual trading plan with risk management involved? Are you prepared mentally to trade this plan with no deviation? That's huge. That's crazy. Do you know how hard it is for a trader to watch their trade, buy in, and then the same day get knocked out of a stop loss and then go back up? Well, that's life. Welcome to the stock market. Do you also have the mental fortitude with your plan to take profits and that bad boy keeps going? Yeah, you better get ready because that's also going to happen to you. Welcome to the stock market. And then lastly, and it's always harped on in my Discord, position size. We're not going to discuss that in this course exactly. I have another one coming out. When it comes to position sizing, do you know how to cast a wide net and not a deep net? That's such a huge problem for most beginners as they get more money and throw more money into one stock. I personally cast a wide net. I would much rather have $20,000 in my account and have $21,000 investments instead of two $10,000 investments. That's my opinion. I think casting a wider net over a deeper net makes a whole lot more sense to me. So we'll discuss that later on in this class as well. Do you actually have your goals in mind? What's your macro goals? What's your long-term goals? Do you know them? If you think that your goals are going to be to trade until you're 80 years old and be active in this and day trade, well then don't change anything probably. But do you have passive income goals? Do you have goals on how to actually go buy REITs and real estate and dividend stocks that pay you without doing anything? We'll discuss that as well. Do you have short-term goals that line up with the long-term goals? We'll discuss that too. And then lastly, with risk management, before we move on to our next lesson, do you understand risk and consistency? It's imperative that you know that risk versus reward and risk management go hand in hand with consistency. If you're not consistent on your risk policy, if you're not consistent on your profit-taking policy, you're never going to be consistent. Without consistency, you're not going to last. Even if you only win 65-70% of your trades, at least you're being consistent. Some months are better than other months. Some years are better than other years, so it's going to fluctuate somewhat. It's all a game of probabilities. But without consistency in your risk management policy, you will never truly know what you have to change or get better at. I want to say one more time before I move on. More trades does not mean more profit. The beginner mindset is like this. Hey, I want to quit my job, so I'm going to treat trading like my new job. Wrong. Incorrect. This is not supposed to be like the employee mindset, which we'll cover. You're not supposed to come into your desk and every single day, I gotta hit my quota of 10 trades. Woohoo! No. There are some days where the best trade is none. There's some days where the best trade is one. There are some weeks I don't buy anything. This week right now, didn't buy anything. The market was selling off. Didn't touch nothing. I don't think more trades makes more sense. The less you can do to maximize your time, probably the better, honestly. And then lastly, with consistency, the more variables you throw into your plan, the worse you're going to be. Honestly, I trade off maybe 8 things. The structure that I have, these 8 things, all I trade off of. Yeah, I look at fundamental, the same EPS, PE ratio, gross margin every single time. Yeah, I trade off of supports, resistances, and trail lines and EMA patterns. Yeah, that's it. I don't go look for news. I don't go search a bunch of crazy stuff. I don't go, hey, this play in particular has this one special thing. Not for me. Sorry. The more variables you have, just the more confusing it's going to get. Find the variables that you want to play consistently that leads a good risk versus reward, and you'll be much more successful than trying to find every single thing. As Mark Douglas said, every single moment in the stock market is unique. You could have the best edge ever and you buy the greatest stock ever, but if some idiot across the country sells the exact same time you buy, it nullifies everything. So it doesn't matter how many variables you know. What really matters is, do you know your variables better than anyone else? That's what's key to consistency and risk management. Next up are the 3 analysis. I really want to cover technical, fundamental, and mental analysis before we start this class again. The reason is we're going to cover each one in about, again, 11 lessons, 8, and then 3 or 4 lessons for each one. The reason I want to cover this now before we really get into the bulk of this class is just like with risk management. I think you're going to go scan for new plays, which we'll get the scanners done soon. You're going to go want to play everything, go try new things. I want you to be prepared, even as you go through this process, at least know what fundamental analysis is, mental analysis, and technical analysis. It's really cool. It's really great. You're motivated, but again, let's really cover our bases and understand what the 3 analyses are and how to properly use them as you go through this course. With that being said, lesson 5, the 3 analysis. Y'all, let's get into it.